September 2008. Lehman Brothers, a financial icon that had stood for 158 years, collapsed into bankruptcy. The U.S. government rushed in $700 billion through the TARP program to keep the system from disintegrating. And Ben Bernanke, the chairman of the Federal Reserve, slashed interest rates to near zero, launching the era of free money and quantitative easing, digital money printing on a scale the world had never seen. But that crisis wasn't just a market accident. It was the symptom of something deeper. Debt had become money, and trust was the only thing holding the system together. Once trust cracked, money itself began to dissolve. Now, nearly 2 decades later, the same warning signs are flashing again. Private credit has quadrupled since 2008. Investment funds outside the banking system are buying up risky loans at record speed. The derivatives market, the same arena that fueled the 2008 explosion, has once again ballooned to over $700 trillion, according to the BIS in 2024. And once again, everything rests on the same belief: debt will always be repaid. But history is never kind to those who blindly trust borrowed money. When debt is tied to inflated assets, homes, bonds, stocks, it only takes one liquidity squeeze to pull the entire system down in a chain reaction. The terrifying truth is this: the cycle isn't new. It's a repeating mechanism. Every generation believes it has mastered risk. And then one day, the market reminds them no one truly controls trust. Beneath the profits and the complex valuation models lies an ancient paradox. The more artificial safety we create, the more fragile the system becomes. And to understand why, we have to go back in time. In the early 2000s, America was drowning in the belief that everyone could become a homeowner. The Federal Reserve's interest rate, just 1% in 2003, turned borrowed money into the cheapest product on earth. Banks rushed to issue what became known as ninja loans: no income, no job, no assets. No paycheck, no employment, no collateral. And yet, you could still borrow hundreds of thousands of dollars to buy a house. The credit machine started spinning at insane speed. Goldman Sachs, Bear Stearns, Merrill Lynch, the titans of Wall Street, bundled those mortgages together and turned them into financial products called MBS, or mortgage-backed securities. Rating agencies like Moody's and S&P stamped them with AAA as safe as U.S. government bonds. Global investors, from British pension funds to German banks, piled in, buying them as if they were gold. But behind the boom was an ancient mistake: the blind belief that home prices could never fall. Cheap money and sliced-up risk made everyone feel untouchable. Brokers only needed to sell the loans. Banks only needed to package and pass them on. Investors only needed to collect the yield. No one was left holding responsibility for the actual risk. By 2006, the bubble hit its peak. Average U.S. home prices had surged 85% in just 7 years, while incomes barely moved. In California, a barista could walk into a bank and borrow $500,000 with nothing but a signature. Everyone believed the market itself had made them safe. But numbers don't lie. Subprime default rates loans to borrowers with poor credit began to soar in early 2007. Those risk-free assets were rotting from within. Inside Bear Stearns, 2 hedge funds worth $20 billion vanished in a matter of weeks. Trillions of dollars in mortgage value turned toxic. A silent domino chain had begun spreading from Wall Street to European banks and then across the globe. On the surface, it looked like a few isolated defaults. Beneath it, the first cracks in the foundation of the modern credit system had begun to open. And then, it started to fall apart. September 2008, Monday morning. Wall Street fell silent, as if the world had stopped breathing. Lehman Brothers, a bank founded in 1850, declared bankruptcy with $613 billion in debt, the largest in U.S. history. An icon collapsed, and the shockwave spread like a financial nuclear explosion. Within 48 hours, global money markets froze. Banks stopped lending to each other because no one could be sure who would survive the next day. The Dow Jones plunged more than 500 points in a single session, erasing hundreds of billions of dollars in value. The global financial system built on leverage and trust began to melt down. Financial giants followed one after another: AIG, Merrill Lynch, Washington Mutual. AIG, the world's largest insurance company, lost $99 billion in just 1 quarter, buried under credit default swaps, or CDS, it barely understood. The Federal Reserve was forced to inject $182 billion to rescue it, or millions of Americans would have lost their pensions and insurance overnight. The housing market, the heart of the frenzy, went into freefall. Home prices dropped an average of 30%, and more than 6 million homes were foreclosed over the next 3 years. Families lost their jobs, their homes, their faith in the system, and the so-called financial geniuses became the villains of history. But behind the sound of collapsing banks lurked something even darker. Governments and central banks faced a brutal choice: let the system die or print money to save it. They chose the latter. And the world entered a new era where money was no longer tied to production, but to debt itself. Ben Bernanke called it a necessary medicine. But when the Fed opened the door to quantitative easing in November 2008, buying $600 billion in bonds and toxic assets, a dangerous new mechanism was born. Every time the market trembled, the Fed printed more. And investors learned the message: risk has been nationalized. From that moment, everything changed. Markets stopped fearing risk because they believed the Fed would always step in. And that belief became the seed of the next great danger. After 2008, the world didn't truly recover. It was put on life support powered by printed money. Central banks became omnipotent doctors, pumping trillions of dollars to keep their patient, the global economy, alive. But what they saved wasn't a free market. They saved the illusion of stability. From 2008 to 2022, the Federal Reserve's balance sheet exploded from $900 billion to over $8.9 trillion. The same story unfolded at the European Central Bank and the Bank of Japan. Junk bonds, stocks, government debt, all bought with money created out of keystrokes. The world entered an era of limitless money. But that money didn't flow to ordinary people. It flowed upward into stocks, real estate, private funds, and the hands of the ultra-rich. The top 1% of Americans now hold over 30% of the nation's wealth, the highest share since 1929. Source: Fed 2023. Meanwhile, more than half the population survives on consumer debt, credit cards, and student loans. This new system has a name: the debt machine. It works like this. The Fed prints money, banks buy assets, prices go up, investors feel richer, they borrow even more. The system looks healthy, but in reality, it's running on ever stronger doses of stimulus. Just as 17th century monarchs diluted their silver coins to extend their rule, modern governments dilute the value of money through credit. Every bailout, every round of QE, every digital dollar not backed by real production is a quiet trade-off with the future. And as always, artificial stability breeds new risk. That risk now lives in the shadow banking system, the vast web of private lenders and funds beyond any central bank's control. By 2024, that shadow market surpassed $70 trillion, according to the FSB. It's where today's risky loans, the modern subprimes, are multiplying. But this time, there's no layman or AIG to blame. The danger is scattered across funds, corporations, and emerging markets. The financial machine has learned to hide. No longer explosive like 2008, it moves silently, invisibly, and it's spreading wider than ever before. The year is 2025. Global interest rates have climbed to their highest levels in more than 2 decades. After over 10 years of cheap money, the world is finally paying the price for its addiction. Thousands of companies that once thrived on low-cost debt can no longer refinance. The U.S. commercial real estate market has lost more than $900 billion in value since 2022, according to Morgan Stanley. Private credit funds, the shadowy replacements for traditional banks, now hold over $2.1 trillion in risky corporate loans. It's a ticking bomb. Shadow credit, high leverage, inflated assets. Sound familiar? That's the DNA of 2008. The only difference now is scale. This time, the system is far bigger, and the danger doesn't come from collapsing banks, but from entities no one regulates: shadow lenders, private equity funds, real estate trusts. We live under the illusion that governments won't let it happen again. But that very belief is the new spark. Every financial cycle in history begins with the same excuse. This time is different. The Dutch Empire of the 1600s, the South Sea Bubble of 1720, Wall Street in 1929, Tokyo in 1989, and Wall Street again in 2008 all shared the same formula: debt, illusion, and amnesia. When the Fed, the ECB, and other central banks are forced to choose between inflation and collapse, they will do what they've always done: print. But each round of printing weakens the real value of money and erodes the world's faith in the system just a little more. Ordinary people will pay the price first. Inflation eats away at wages. U.S. consumer debt has hit a record $5 trillion. Emerging markets are facing currency crises as the dollar strengthens. And when the wheel of credit slows, the global market will relearn the old lesson: no one is truly rich if everyone is in debt.